Welcome to your ETF Edge, your go-to place for everything exchange-traded funds. I'm Leslie Picker in today for Bob Pisani. With markets coming off a topsy-turvy week on Wall Street, questions abound about the resiliency of the consumer in light of Delta. That's led to a significant repricing of the growth risk, with big banks like Goldman Sachs and Bank of America Merrill Lynch downgrading their outlooks for the third quarter as companies reassess the strength of the reopening. So far, retail earnings going strong, but investors are finding it harder to ignore the slowdown in high-frequency data, softer retail sales, consumer sentiment, and home builder sentiment, plus growth concerns in China and abroad. Joining me now to break it all down is Brian Lake, head of America's ETF client at JP Morgan Asset Management, and Todd Rosenbluth, senior director of ETF and mutual fund research at CFRA, and Tina Herrera, chair of the YWCA board of directors. Brian, what's happening here? Because we are seeing so much kind of differing data. You've got the high frequency data telling you one thing. You've got kind of more the macro data telling you something else. It feels like we're at this inflection point where the cases are rising, yet more people are getting vaccinated. And of course, with the Pfizer full approval of its vaccine, seems to be like it would be some good news for the reopening trade. What's your sense?
Yeah, you're right. We are at an inflection point here, but I think it's important for us to kind of look for the signal through the noise. And when we take a step back, we can see that the data does continue to get better. Maybe we're at a little bit of a pause here, but I do think that there's a great opportunity for the reopening trade to be on. Obviously, today we're seeing the markets reflect that as well. I think what investors are really doing is they're really focusing on valuations. They're going to be looking at quality balance sheets, making sure that they understand the companies that they own, maybe looking more towards some value names versus some of the growth names. But we do think that there's an opportunity for investors to continue to participate in the reopen trade through the end of the year.
Todd, you hear, the term investors focusing on valuation. I'm sure a lot of, schooled financiers out there would find that to be a nice relief given what we've seen recently. Do you believe that to be the case, especially with, the potential for some tapering activity? Does all of that kind of produce grounds for more of a value trade to come back into focus on a more sustainable basis?
We think so. So much of the first half of 2021, value outperformed growth, and the pure or more focused value-oriented strategies did even better. Growth returned over the summer, but we think we're going to see a rotation again back towards value-oriented ETFs, whether they're the broad market ones like the iShares Russell 1000 Value ETF, or the more targeted and focused ones. So Invesco has an S&P 500 pure value ETF, RPV. iShares has a focused value ETF, FOVL. Those really outperformed because of the strength of financials and some of the more value-oriented and cyclical sectors. We think that's going to happen as we make our way into a return to school and a return to work for many people.
Brian, do you think that the factor-oriented ETFs are kind of the way to go right now, or is it better for investors to be sector-specific? Are there other types of characteristics that you would advise when looking at investing in ETFs, given this kind of uncertain, uncharted territory we're in right now?
Yeah, I think it's also an opportunity to look at active ETFs. And I know that we haven't spent as much time talking about active capabilities delivered through the ETF vehicle over the years, but now we think that's something that's going to come to the forefront of investors' minds. Dispersion between returns is going to be more pronounced given all the uncertainty that you've talked about. And so investors looking to get outcomes through active strategies is really a way that they can enhance their portfolios. We're obviously looking at delivering some of our active strategies through the ETF wrapper. One that's been very popular lately where investors are really enhancing their income on their portfolios is Equity Premium Income. The ticker is JEPI. This is an actively managed equity strategy where the underlying holdings are all quality names, but then we're doing covered call override on that to generate income for investors that are really in an income-starved world. So active is maybe a way to be thinking about that. Of course, yes, factors are important. As Todd pointed out, the value factor is something that investors are looking at, as well as quality. We offer single factor strategies, JVAL, JVAL, and JQA, JQUA. being the tickers there. And again, those are ways to isolate portfolios and tactically overweight some of those factors that may be able to identify some of those valuations or those quality balance sheets that investors will benefit from as we go in towards the end of the year and participate in this reopened trade.
Interesting, very quantitative in nature there.